Something that we recently published, well, there's a paper that we just wrote about what we're now calling the country size effect. There's been very little research done on this, but it's another factor that we have sort of done some work on it. It's about having more exposure to smaller countries than larger countries. Now, on the point about what's done well in the last year, I think for any advisor out there, we're talking about factors and security level research, but the real reality is, the more money you had outside of the U.S. this year, the better you did. That was the real big factor, I guess, currency or, foreign market exposure. And then a lot of these themes we talk about at the security level also work in other countries. But this idea of thinking about your country weighting, a lot of the concepts we're describing, like price to book, price to earnings, you can almost think of countries as stocks and think about price to book or price to GDP. And what you'd find is you'd have, if you followed these ideas at the country level, you'd probably have a little more exposure to smaller countries and a little less exposure to bigger countries, of course the U.S. being the biggest country if you rank it by market cap. I think there's a lot more research to do there, but looking back over the last year, thinking about your global exposure and applying a factor kind of set of ideas to that might be an interesting thing for advisors that are watching this to think about.